Hey traders, happy Tuesday. Welcome to Charts and Coffee for August 3. Great to see everyone. All right, so yesterday we took a look at the economic calendar and discussed what we're going to be dealing with as the market starts to inch closer to non-farm payroll. Of course, job numbers, inflation numbers, GDP numbers are all going to be pretty darn important as we're trying to get a read on how the Fed is going to be messaging their path to taper, their path to 2023, and to eventual rate hikes. And of course, who's going to be listening with very, very, very bated breath? S&P, NASDAQ, Dow. So, as always, if there's any macro that matters across the board, it's the messaging from the Fed. They've got their hands on all the gears of the economy. And so that's really going to be how we sort of micromanage what we think they're going to eventually communicate to us. It's going to be basically leapfrogging from one data point to the next. So with that being said, am I bullish? Yes. Going into August, I know that might be a little weird, but yesterday in the free video, if you check that out at the Simpler Trading YouTube channel, I walked you through sometimes the fallacies of a very singular approach to understanding seasonal, cycles, tendencies, what tends to happen during certain times of year, and how the look back that you are measuring that tendency or that cycle based upon can really change what it is that we can anticipate. So I've been using a 5-year look back. Check out that video when you have time later on today, maybe after the close, and you'll get a really good feel for what it is that I'm preparing for in August. All right, so with that being said, let's jump into some of the questions. First one, John, TLT, which is, really based upon my take on ZB, the 30-year futures contract. The gift that keeps on giving, it's a double green. Yep, it's been double green. Well, let me show you. It's been double green since, as you can see here, basically July 7. Sorry, jumping on a little cough drop here today. A lot of hours of chat to come. So if you've ever wanted to understand double green, the direction that I'm looking at, the dollar bonds and gold in, I'll be in the futures and options room quite a bit. Bring your questions. Love to do some rapid fire analysis so you guys understand a little bit more about the way that I'm tackling this market. So preemptive lozenge. All right. So I love ZB, John. And what I'd like to do, we're playing the idea. I'm in a combination of ZB and TLT. I know not everybody wants to trade the futures contract, especially overnight. Sometimes margin is cost prohibitive. And a lot of folks don't like to be in overnight futures positions. They'd rather, day trade, and that's totally fine. TLT becomes the natural extension, the additional position, the alternative position to it. So TLT is not where I do my analysis, though. And if you've been following any of my work in, any of the rooms when I'm in it, in them, if I'm looking at the SPY, it's because I like something on ES. If I'm in QQQ, it's because I like something on the NQ. If I'm in TLT, it's because I like the clarity of ZB. So it's we want to continue to buy the dips. We're in a recent dip buy, which we sat through about 5 sessions of just back and forth, but it's a double green. So the probability is we'll continue to move higher. And if and when, because of course we're going to see a move to the downside at some point, right? And I hope we do. I'm rooting for the bears. I'm waiting for another move like this and another move like this. Why? Because I'm going to buy into it again. So this is not the trade, though, for me in this environment. However, I am exceedingly grateful to the corrections that come based on that weakness. And absolutely, I'll wait for another one. Will not be surprised if in this area we get another move to the downside before we test. I don't know that we're going to go to new highs. I'm not paid to, play fortune teller. But as long as we continue to move higher, we're already looking at a nice profit. And I just would love to see us retest this area. The more we retest the high, the more likely I feel we're going to break it. So let's retest it like a jackhammer, and then do it again and do it again until we finally break through. All right. So yeah, double green. Absolutely. This has been one of the better setups for us since June, just continuing to buy those dips since about 158 and change. All right. So next up, thank you, by the way, John. Foxtown, I'm thinking CRM is quite the setup. All right. Well, who am I to disagree? But, let's talk about why I may not be quite as enthusiastic. So first of all, would I anticipate overall a market that would continue higher? And the answer is yes. However, right here, right in there, this market went from, you guessed it, double green to now more of a neutral sideways market. And it's that lower row of the JT multi that dictates that. With that being said, do I want to focus on oversold support levels in order to get long from the lower end of this range, right? That's what I would say. I have a bullish bias. I'd like to find the market down to some sort of support level, maybe the lower half of the range, maybe the lower quarter of the range, and then get long, right? I would presume that the path of least resistance is going to continue to be up. Now, I will say the last couple times that we have tested the 55 exponential, which you can see there with these magenta or purple colored dots, that's the 55 simpler propulsion. Last time we were in this area, we were able to break it. I mean, there's no doubt we saw a little bit of movement below it, but this seems about as good a spot as any to start thinking about those long positions, remembering that the area from the 55 down to the Darvis is probably going to be where your buy zone is waiting. So use a ready aim fire, use a slow stochastic. Maybe you're going to look for a reversion to just below the first standard deviation of the V-score. Whatever it is you're using, try to use maybe some volume ledges. I mean, look at this gorgeous volume ledge right there. Use something else aside from simply price. Support resistance is price. Exponential moving averages, including simpler propulsion, it's just price. What's the layer below that? What's submarket? Volume, right? So I would love for maybe the market to get down to around 236 and a half, that nice volume ledge. But by the way, we're at a volume ledge right here around 239. So thanks for the question. Moving on to, hey there, Debbie. I know that FCX is not double green, and this is a play on copper. Right? I look at FCX as really, in many ways, the stock alternative to copper. Right? It's our proxy. However, there's a possibility to go. Is there a possibility to go long in the future? It's been on my watch list. Mine too. But remember that in June, the Federal Reserve pretty much clobbered that reflation trade. So I'm not as wild about it. Now, having said that, we have found our way above the resistance of the wave. Accompanying that is this nice point of control right in here. It's the most volume that's occurred within the viewable area. So going back to early May, okay, that's the most volume that's occurred since early May on this chart. So above a point of control, broke the 34 EMA wave. Clearly you can see the volume ledge because that's going to accompany the point of control. I'd like to see us above this volume ledge, which I would consider support. And there's a lot of gravitational pull in this area there. But, I don't love this setup. I don't have a double green yet. However, maybe a quick pullback, it could merit something aggro long. Freeport McMoran is not a cost prohibitive option. It's not super expensive. Of course, the expense of your options and of course your size is part of that formula to risk. So I'm feeling pretty good about the potential for this to look interesting. But in a world where we're not lacking double green sectors or indices or stocks, I'm not going to say that I would love to prioritize a non-trending market. You know me, can't help myself. All right, next up, Terry, Facebook. I like Facebook. I like the pullback. We've got earnings in the rear view mirror. Earnings have created this volatility, this pullback. Thank you, earnings. I would rather be in pre-earnings, and then I'd rather look for post opportunities. And I'd like to see something that looks a lot like what we saw back in here happen in this nice volume zone. Preferably the market staying above the 55, but let's not rule out that the market could get down there. So your zone is kind of wide, but it is one that I believe is buyable on the dip. Now, remember, those of you, well, if you caught the webinar, by the way, that I did yesterday, you can check out the replay. I just gave you guys a replay here. If you registered, I believe the replay will be going out sometime today. If not, you can just head on over to simplertrading.com/scale-replay. And XLC was one of the names that we had discussed as a proxy for Facebook. And XLC has been a position that we've been in the Sector Secrets Mastery because it allows us to take advantage of Facebook, which is not terribly expensive, but it ain't cheap, right? And it allows us to take advantage of Goog and Goog-L, both the alphabets, through one high concentration weighted ETF. So I've got my eye on XLC, but I think, Terry, we're definitely looking at the same thing here in terms of the opportunity that the pullback can present, whether you're looking at the boat level or whether you're looking at the tide level. The ETF would be the tide, Facebook, Goog-L, big boats, but still boats all the same. I think for sure, I'm definitely seeing an opportunity brewing here. All right, next up is, hey there, William. Is it true that you first need a breach before you can surf the wave? Yes. Okay, easy question. Absolutely. You do need a breach, ideally, before you can surf the wave, which means that you cannot actually surf the wave, surf the 34 EMA wave, buy the pullbacks within the context of an intraday uptrend until the market's taken out the clearing range high or the clearing range low. Now I'm going to focus on the high because we still have directional bias. That's clearly bullish, especially on the NASDAQ, especially on the S&P. But what about the Dow? That would come in third place for me. The Dow is not a double green market. The Dow is absolutely still in this back and forth chop, even though it looks like it's trying really hard to try to organize into an uptrend. It's not there yet. You're going to be better off trying to find individual sectors that are relative outperformers within the Dow, like healthcare. But the Dow, I'm looking for a little bit of a pullback as we exhaust at the upper end of this range. The Russell is also not in a trend. The Russell recently bounced off the oversold level. And, I'm looking for the Russell. It's chopping around in the middle of the range. Pretty normal gravitational pull at the 50% of the high-low range that the Russell's been chopping about in for a long time. And I am actually looking for the Russell. I'd like to see the Russell continue its journey from the 200 EMA, from the oversold zone. How many times have we bounced down here? And I'd love to see it continue up into, minimally about just clearing 2307, 2305, getting up into that area. And then maybe even, completing its journey up to almost 2350, where at that point, it's going to make a lot of sense to maybe look at exhaustion. But if it gets down to this area again, let's look for another buy. All right. So, remember, surf the wave is a trending strategy. It does need the clearing range breach. And additionally, as you can see amongst the four indices, S&P and NASDAQ trending, Russell and Dow, not so much. All right, so let's move on. PayPal, sure. Okay, so PayPal. I'm going to leave PayPal alone for much the same reason. For now, I'm being very patient and leaving Amazon alone. I actually like Amazon a little bit better than PayPal, but the setup is going to be the same. Looking for a very specific trio of candles. This is looking like it's going to be a minor low. Although, it's going to be a pretty extreme one. But what I'm looking for is a market to create a 2 or 3 candle pause pattern before you get a reversal. The market has to pause, right? The pause or the stall is oftentimes really underestimated in terms of the importance of a market that's been recently catapulted higher or sent sharply lower. That pause is oftentimes overlooked. Folks are just too willing to look to buy the low, as if we can, catch that proverbial falling knife. So what I'll wait for is the pattern to form, and I don't quite have it. Again, not really a trending market. Clearly, it was right, which is why I like the pre-earnings and the post, but not the during. I'm very seldom in a shockwave type setup that takes me through the volatility of earnings. Almost never. Very rare. And the reason is for exactly what we're seeing on PayPal right here, where the weeks leading up into earnings were exactly what we want to see in terms of that 642 earnings window. Post, let's be patient. And Amazon's going to be, in that regard, the same. Now, as far as retracements go, let's get the pause first before we start assuming the market's going to be able to bounce and make a retracement. But I would look for a move back to 289, right? I'd rather pull a Fibonacci on whatever ultimately the minor high to minor low move is, and I'll look for right now. If we don't make a lower low than what we have here at 270.43, I'll look for 289 as a place to retrace. Any thoughts on Mastercard and Visa? Not so much. I mean, just fresh off of earnings, not really great structure in front of earnings, not really great structure after on Mastercard. Visa does look a little bit better. So if I had to choose from a relative outperforming standpoint, I'd go with Visa. And I would not be surprised. I would probably focus. I mean, clearly we're here. I would focus likely on the lower half of the wave, possibly all the way down to the 55 exponential, but I would be a buyer. And, if you look down here, what do we have? Good old double green, right? Good old double green. So yeah, this is definitely an environment where I'd look for the pullback buy, right? I mean, how many times have we seen it? This was in the yellow, right? You can see through here, but remember that the trend that preceded the yellow was green. So it's far easier to be a buyer than not. I won't change that here. Now, the only other thing I would also mention is, know where Visa is, right? Within the context of the passive investing universe at ETF, where is it weighted? Find the high concentration weighted ETF. And you can definitely find, ultimately, you could definitely find sort of the other boats, right, in the tide that can ultimately give you some clarity, maybe some other relative outperformers. Remember, if you caught the webinar last night, what I love is that relative outperformance. That's the way I scan the market. Look at a group of stocks that are lumped together because what they have in common is they're all part of the same sector ETF, or they're all part of the same index. And then I look at them and say, okay, which one of you has the best structure? Which one of you is tracking maybe better than the sector? Which one of you is tracking in a way that would suggest better follow through, right? And then, it's that relative performance. It's that watch list building, gang, that's going to save your, it's going to save your six when the markets do get volatile. Find the resilience, and resilience and relative performance tend to be traveling together. All right. So with that being said, that's a wrap on today's episode of Charts and Coffee. Thanks as always for joining me. And I'll be in the futures and options room for the first hour here in just a moment. So I'm going to actually go switch on over to those rooms. I'll see you guys in those 2 rooms in about 60 seconds. Be good to each other, gang. I'll see you tomorrow, or I'll see you in the chat rooms here in just a bit.